Hi everybody, welcome to the Finance This Property That podcast. My name is Dion Fernandes and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Welcome everybody, part two of our podcast today with Scott and Phil from WealthLab. So this part is around a topic that I discussed not too long ago in a previous podcast around a purchasing structure which is called self-managed super fund, or for short SMSF. So today's podcast is a insider's guide to SMSF and what is it, what type of lending can you do in it, and really who's it for, and why would you choose to do this. So probably really appropriate that I got two financial planners to talk about this as opposed to myself, because I only know you can lend in it, but there's obviously a few other things you can do and go through some pros and cons.
Yeah,
Sweet.
beautiful.
Well, let's just start with a basic. Actually, let's just start before you listen to this podcast. Make sure you listen to the first podcast. Give you a bit of insight into what these guys do. But guys, what is a self-managed super fund, and why would you have one?
It does what it says on the box, I guess. So, yeah. A self-managed super fund is effectively you becoming the trustee or the person that's responsible now for your own superannuation. So, much the same as one of the industry funds, an Australian Super or something, have a trustee that's taking care of your money and looking after your superannuation savings. But that's you taking on that role and doing it yourself. Very simply, that's probably the easiest way to think of it. Yeah.
Okay, sounds like a lot of hard work, because I'm only used to like one
Yeah.
type, right? To the industry super fund. I think mine's Australian Retirement Trust.
Yep.
So why would you do it?
The most common reason that we would see people doing a self-managed super fund would be purely and simply to be able to invest in assets that they can't really do through a traditional super fund. And then to take that a step further, the most common of those assets would be people that want to invest in a property. It'd probably be the most common reason we would see someone wanting to set one up.
Okay.
You see some people that want to set one up just purely because they've got some sort of a view on the industry or how their money's being managed and those sort of things, and that's cool. But I'd say the most common reason we would see people is because they want to buy a property.
Yeah, because back in my banking days, I used to set a lot of these accounts up, for people to transact on, and one of the main reasons what they were saying that they wanted to do a and I didn't really understand it back then, was around the super funds are just costing me fees, and it's not performing, and I'm going, okay, but you're just putting all the money into an account. But I didn't understand back when you were learning learning that.
I think so. So if you look at sort of from a historical perspective, the self-managed super fund has been around. I think I might be wrong, but late 70s, something like that. The concept of mandatory retirement savings or super guarantee, as we know, was 91, 92. That's when that was put in place. But the concept of self-managed super fund existed before that. And it was really, you take total control, and then we've sort of had this like compression and expansion of different types of options. Sort of say the industry funds, and we were in this seminar recently where they were saying ART and Oz Super are like nearly 20% of the total market of those two super funds.
Wow.
Have nearly 20% of the entire population in them. So there's two gigantic monsters here. And there's also some other options around what we often will work with clients, which we refer to as wrap accounts, which does pretty much everything you need. You've got direct share access, you've got overseas direct share access, you've got cash term deposits, et cetera, within these wrap accounts. And so if we go sort of from size, you've got the industry funds here, you've got the wrapper funds here, and then you've got the self-managed super fund here. And the self-managed super fund will allow you to do pretty much anything when it comes to a type of asset you want to buy. So if you want to buy, and this was one that we saw, which was kind of a bit crazy, but if you want to buy a property in the US, you can do it with a self-managed super fund. If you want to buy antiques or classic cars with lots of asterisks, you can. You can buy artwork, but you're not allowed to enjoy it.
Yeah, don't look at it.
Yeah.
Walk around with a blindfold on. When
So
you
the summary is
just
that's a tough one to do. But in terms of like collectibles, music, You can buy patents. There's a lot of options you can. Yeah. What else? Royalties. You can buy royalties as well. So you can buy water right royalties. That's a thing that comes out. So the Murray-Darling Basin. So people coming through New South Wales. Then down in Victoria, there's water rights that you can buy and sell and trade. There's just a huge amount of stuff that is an investable asset that you can then put inside a self-managed super fund.
Far out.
Yeah, it's pretty wild.
Yeah.
Like you literally are ripping the guardrails off, and that can be a great thing. It can also be a massive risk. So
The reason why I thought this conversation needs to happen is I have a lot of clients that have got self-managed super funds, right? But what I'm finding is that I don't really know what their purpose of it was, and they're coming up to me and going, "Hey, I want to buy this property, that property." And the first question I'm asking is, "Great, how does that actually fit in with your strategy? Who's done your strategy? Who's actually talked to you? Whether this is the right move for your SMSF, and whether who's controlling that apart from yourselves? Who's controlling the investment and the running investment?" So, do you? Obviously, that's what you guys would do, right?
Yeah. So.
Well, I mean, probably people will have a much closer relationship with their accountant because a self-managed super fund has to be audited every 12 months.
Okay.
So going through the audit process, you actually need to show exactly what has occurred within the fund, and you need to ensure that you haven't received a direct benefit from that super fund. So that's a common issue. Around the sort of the duties are. It needs to be anything that the fund does needs to be at arm's length. So you can't deal with, say, yourself or direct family members or really anything that's sort of on the edges of I bought a factory, but I'm giving myself a discount or something like that. So there's what's called the sole purposes test. So super funds in general exist for a sole purpose, which is to provide for a retirement income stream. So that's the sole purpose test. So that's something that the accountant and the auditor will be checking every 12 months. So most people will usually defer to the accountant and auditor. The accountant and auditor, that's not their role. They don't do the strategy. They'll just do the tax. So they're actually what's happened in the last 12 months.
Yeah, they're looking backwards.
As opposed to forwards.
Yeah, that's exactly right. Whereas it's our job to look forwards. And exactly as you're saying, how does that fit into the broader strategy, the broader retirement strategy? What's the purpose of what you're doing? I have people all the time that ask me, come in saying, I want to set up a self-managed super fund. You ask them why, and they don't really, someone told me to. Okay. I want to buy some shares. Well, that's cool. We can do that a lot cheaper and a lot more simply elsewhere. You don't need to, understanding that why. But then, diversification is a huge one. You get someone that's got 200 grand and they're going to chuck the whole lot into a property. But then what happens? You've got your entire retirement basket is in one asset now. It's a huge amount of risk, and people don't realize it because everyone thinks property's safe. But what if the house burns down?
But if that's what you want to do, like if you think this is a great thing. Okay,
sure.
That's okay. You get that choice.
Yeah.
Where with the say, for example, a wrap account or an industry fund, you'd have no choice.
Yeah,
it's true. You just get slushed in the same bucket. So if you want to take that thing, and it is a high growth, sort of a higher risk strategy because you're a concentrated asset.
Yeah.
It's not diversified. It's just that one thing that's right there. And it comes with more administration. You've got to make sure that the upkeep's maintained. You've got to make sure that the neighbours are okay. You've got to deal with the tenants. So there's a lot of admin that comes with just having an investment property in any way. And then you add the layer of a self-managed super fund. You just need to be organised and aware of it.
And have the right people behind you.
Have the right people behind you. Yeah, absolutely.
Yeah. So if you have an industry super fund, right, let's say there's 300K in industry super fund, that industry super fund also has insurances on it, in it. If you close that industry super fund, you lose all the insurances, I'm assuming, as well.
Yeah.
So is that's probably another risk that you have to mitigate at the same time?
And it's actually something that's quite commonly misunderstood, I suppose, by people that go into self-managed super funds and that sort of thing too. You have an obligation as a trustee of a fund to have an investment strategy. So you need to have a documented process and consideration decision of how that money is going to be invested. And part of that also, you have an obligation to have considered insurance. That's not to say you need to have insurance, but you need to be able to demonstrate, should a regulator come looking, that you've actually considered it and that you've made an informed decision that no, we don't need it, or yes, we do, and here's what we're doing about it. So to simply roll your money over from your old fund and lose the cover, it's not going to tick a box for.
You could still have both though, eh?
Absolutely, yeah. So, there's no reason why you couldn't keep some there. There's no reason why you can't have insurance that's owned by the super fund. There's no reason why you can't have personally owned insurance, but document that as part of your investment strategy. That yes, we've considered insurance. We hold a personal policy. We don't need it.
It's almost like a business plan.
It kind of is.
Yeah,
and there's a million
is.
ways you can address that, and that's absolutely the sort of thing that we're getting into with people. If if we're taking on self-managed super fund work for them, that's a big part of it.
Yeah. Okay. Cool. So, all right. Let's say the strategy. Clients come to you. We've got $350,000 in my Australian retirement trust, and I want to do a self-managed super fund, and I want to buy a property in it. Right. So obviously, there's a few things that I consider from a lending point of view. You've got limited lenders.
Yep.
Right. So that's a
How many are there?
look, all the big banks out. Gone. You won't.
What about the like the sub tiers of the
Yeah,
big banks?
sub. So
like a Bank West or
No.
a BO.
No.
Or BOM or something like that.
no. So a lot of your your normal tier 1, tier 2 lenders, they don't touch it. So you go to someone like a Latrobe, Mortgage Mart do a really good product. Wealth, they're pretty much the same product. You've got Better Mortgage Management, but also
First Mac a bit.
First Mac. There's a few out there that have it, right, and it's just about they've all got different policies, and they all have to. This is where myself, I will go look and get those policies and just understand, because yes, you could have X amount of dollars in there, but if it doesn't meet their test, their liquidity, some have liquidity tests. How much money have you got remaining over? The costs, you've got to put in all the costs, and you can't have any additional contributions. It's just like, well, what are you contributing and what's the max you can contribute to, and that's it, plus your rental income. And it's got to be able to service. There's so many things to consider, right? And so there are limited lenders where you can go to it, but there are some really good lenders. There's, the one thing I'll say is if you have a self-managed super fund, or if you guys know of anyone with a self-managed super fund with a major, they don't really, they won't reprice them. I actually refinanced one out of a major that was sitting at about 11.5%.
Yeah, okay.
Yeah. It was only about 180, 200,000.
Was it just like an old?
It was just it's just been there forever, but 11%. It was only making 5% yield.
Yeah.
Well and truly
Paying
upside down.
11. How's it?
Hectic.
I go, hey, let's just fix that up for you. And they weren't. They were no help. They go, oh yeah, well, we're not pricing it. It's almost as if they want you to remove it off their
Yeah, they're
book.
trying to.
Yeah, that's right.
So-
Yeah.
Now, I think I'll answer your question with that you were alluding to before, which is like, all right, so we've kind of hit the points of like, so the reasons to not do a self-managed super fund are do not do a self-managed super fund if you just want an easy life, because it's not. There's admin, and if you're doing an investment property, you're dealing with investment stuff. You're dealing with tenants, you're dealing with agents, you're dealing with upkeep.
Yep.
Right. Why would you do it? Well, look, there's certainly some benefits. So, for example, let's say, someone came to us and let's say they had between $300,000 to $400,000 or whatever it is in their balance. We will do that. We'll review. We'll identify that they have a clear goal that that's what they want to do. I want to buy an investment property because I believe in it and I think it's going to do better, or I think it's going to be, I want more control over my retirement. Whatever your goal is, great. We're going to document that very clearly. Then we're going to talk to you about, all right, so let's work with the actual strategy. Usually a client will have a property in mind when they come to us. All right, they've got a type of asset, 3-bedroom house, 4-bedroom house in this certain suburb, in this certain area, this sort of rental yield. So, because it's just maths, because if you're not living in it, it's just a pure investment thing. So we're going to go, great, no worries. We'll purchase this property at this price. This is the loan to value ratio of what we're going to be doing. And what we're also going to do is we're going to create a diversification strategy in which we also invest a portion of funds into a diversified asset pool outside of the property. So now we're splitting it. So you've got that one property here. You add some leverage, which is a higher growth strategy, but that's what you want. And then we also invest that through a typical managed fund, cash, bonds, stocks type investment. Yep. So we run this dual strategy. And that works really well for a lot of people.
That makes sense as well, because if one's performing really high and the other's performing really, not as good as well, you kind of meet in the middle somewhere, right?
Yeah, the diversification is it's risk mitigation 101. It's the basics of good investment. So, it's important.
Yeah. Because look, I know that in the self-managed super fund stuff, they ask you to when you're doing the lending, you set up a different trust, right? The Bear Trust. So, from a financial, tell us the why behind setting up the Bear Trust.
Yeah, look, I think realistically, regulators just love making stuff difficult.
It's asset protection.
It is asset protection.
The
but-
whole point of it is that, the loan, as you would know when you're writing the loan, it's a limited recourse borrowing arrangement, which in plain English just means that if you default on that loan, the bank that can't then come after your other superannuation assets. It's limited. Their recourse is limited to that property.
The property, yeah.
Now, you may well have a personal guarantee, so they may come and try and come after you as well. But the whole idea of the bear trust is that the property and the lending is held separately, so there is no recourse to the lender on any of your other superannuation assets. So
So it is a bit, that's definitely big asset protection piece. So that's another trust that you have to. Do you have to audit that one, or is it just saying?
It's all treated as the one sort of thing at tax time when you're doing your tax and the audit and all that sort of stuff. For all functional purposes, you're really just sort of assessing it as the one entity.
Yeah, and if I wanted to buy another property, I'd have to set up another bear trust.
Another bear trust,
Assuming there's lending in there.
Yeah.
Yes, correct. Yeah. So all the lending's there. It can all just go into the fund once the lending's paid off. But each individual limited recourse borrowing arrangement can only be over a single asset or a collection of like assets.
Yeah.
I get technical about it.
In one of my previous podcasts, I talked about 3 different types of lending structure, and the SMSF, you are very limited in what you can do, right? Because you can't actually borrow against the SMSF. You can't, like the SMSF, let's say you bought it for 800, now it's worth $1 million, you've got a $600,000 loan, you can't go back and restructure that loan and take the money out. It's very limited in what you can do. You either have to sell that property, put the cash back in, realise the gain, and then go again. It is very limited in what you can do, but I can see value in it as well.
Look, I mean, it's, like I say, some people really believe in property as an asset class, and I've got a property through my super, full disclosure. And it is a good way to be able to do that. It's and have a bit more control. You can control your tax planning a lot better as well. You can control your estate planning really well. There's all sorts of benefits that come with it, depending on how complex your situation is. That's probably beyond the scope of what we talk about today. We'll be here all day, but look, they can be a great structure in the right circumstances for sure.
Yeah, 100%. I guess from my point of view as well, from a lending point of view, if it's in the self-managed super fund, as long as there's a couple of other parameters met, it doesn't really affect the lending outside or your borrowing capacity outside. It does if you're actually making additional payments to meet serviceability on that super fund, right? Or that debt in the super fund. But from my point of view, it's actually you can purchase another property, you actually another one in your portfolio. It's just sitting in a different investment
in a different bucket. Yeah. Look, and there can be some really great tax advantages and stuff to doing it through super, depending on your circumstances and those sort of things. You sell the property when you're in retirement. If your accountant's done his job right or your advisor's done the job right and you're set up in pension phase, you're not paying capital gains tax, which can be a huge saving. And it's got to align with your goals and the timing around when you're selling, all those sort of things. But there can be some really great advantages from that sort of perspective as well, which is good. But there's also a lot of traps. You get the structure wrong, and you can cause yourself a world of hurt as well.
Oh, it's just the same as not getting your borrowing structure and your borrowing strategy right at the beginning. I've got heaps of clients that end up putting all their borrowing in their personal name, and now they're capped out. But if we had to switch them over to trust, they're basically now going to pay the stamp duty and the capital gain. So it's about trying to get in early. It's just comes back to our previous conversation where it's like, well, it's harder to do stuff when damage is already done. We've got to unwind it. It's going to cost more. It may not even be able to get done. But if we actually have the conversation and strategize right at the beginning, there's less issues. I mean, there's always going to be something that happens, right? There's no crystal ball. But do you agree on that? Or?
Mate. Yeah, that's what you've got to. There is an element of trying to predict the future, especially when you start thinking about like trustee structures and stuff on the fund. I won't get too technical, but there can be significant stamp duty and just administration burdens and stuff that can be triggered if you have that trustee structure wrong and there's a divorce down the track. The
summary is just to make sure you've got the right advice.
Yeah, 100%.
Make sure that it comes from additional complexity. It comes with additional levels of control that you can do yourself, and you just be prepared for some administration. Yeah, and that's really
prepare when you're setting it up. Prepare for the worst to happen. Prepare for the fact that I might get divorced. One of us might die. Something's going to happen. Prepare for that up front because restructuring later can be expensive, or getting it wrong, stamp duty, all sorts of stuff. So, get the right advice up front. Don't just try and wing it. It's a lot of unintended consequences.
Yeah, just insurance on the property as well, making sure that's sorted.
Yep.
Or like flood risk, it's around Queensland, or that drama.
I mean, buying the right property as well, right? You're spending money on someone to do a plan. You're spending money on your accountant, right? You 9 out of 10 people that I deal with are not property experts. They don't know the market. And I always introduce them to, hey, look, why don't you speak to a buyer's agent? Why don't you speak to a property expert in that area? Or you can do some of the research yourself. But yeah, just at the end of the day, take those extra steps to ensure that you're actually making the right decision.
Yeah.
Yeah, and like you said, putting the wrong entity on the contract.
Yeah.
I just recently did a self-managed super fund purchase. And I saw the contract, and I said to my client, I go, do not sign anything till we look at the draft contract, because I can tell you, I've already got a bad feeling about the agent. I got a bad feeling about the property, and when it's smelly, it smells, right. I'm going, can you just, and I don't look. I'm not an expert.
So what was wrong with it?
They had the wrong entity on it. They had the wrong ACN on it, and that was just two. And I said, just please send us to your solicitor, who was also one of my close trusted advisors at JHK Legal, and they found another 3 or 4 things wrong with it.
Yep.
So we see a common thing of quite often is like the Smith Family Super Fund as trustee for this, and sometimes the will be missing, something like that. Like there'll just be an and will be missing.
Smallest things can cause the biggest headaches.
Yeah, you get a
just
wrong
transposition errors. I know it's like a weird thing that we're talking about here. But that's like a common.
No, it's the attention to detail piece that could cost you double stamp duty at times.
Yeah, that's right. Yep.
We're already paying enough. How do we? You don't want to pay another.
You don't want to gift anymore to the government.
Exactly, and this is the power of advice, right? Yeah. Having the right team behind you, getting the right advice, and if we didn't do that, right? We had a 7-day finance on that thing as well, and that sort of bought me a bit more time, because I'm like, yeah, cool, we can order the valuation and stuff like that, but get that thing right.
Yeah.
Because no one's going to look at that. That's wrong. And I'm no expert, but I can see it's glaringly obvious. And this is where that pressure's coming from, you're saying cash offers and making the best offer. People are sort of getting that, I've got to make the best offer, and they just they don't stop. They don't have to sign that contract straight away. The contract's got to be right.
Yeah.
People put special clauses on there. Oh, we don't have a trust set up yet, but I'll put my name on there, and then we'll put a special clause saying that we can change it to a trust. And I found out that, look, as soon as that special clause is made, you can potentially be up for double stamp duty.
Well, the thing is to be aware,
Because
a lot of this stuff is state based too, and and it's not. It's like actually really common where people with an SMSF are buying a property in a completely different state.
Yeah.
No idea about what the rules and laws and all that sort of stuff. And you may not have engaged a professional down there. You may have engaged a local professional that's familiar with Queensland laws, but maybe doesn't understand Melbourne.
Or WA or
whatever. So that's a really common trap that we see as well.
And I think that's why, again, get the right people behind you, because I know my team at JHK Legal, they do Queensland, New South Wales, Victoria.
Yep.
So I've got pretty much your big three buying states, right, at the moment. Western Australia, yes, but I haven't done a lot of Western Australian properties. A lot of my clients are still sitting in this eastern corridor here, which is great. But man, just that one extra check. Yes, you'll have to pay for it.
Yeah.
But it's better to pay a couple of $100 than tens of thousands, right?
Yeah. Now, the other thing that's it's not that uncommon is because particularly with younger clients or younger people, my money's in my super. I can't touch it now. And they may be almost a little bit more flippant with it it's a large chunk of money. It is your money, whether you can touch it now or not for 20 years, it's still your money. You still need to put the same level of due diligence into anything you're going to invest in or anything you can do with that money as what you would if you just pulled $100,000 out of your bank account. It still needs that same level of care and attention. And sometimes, it's almost a different. Well, I can take a punt with this money because I can't touch it anyway.
Yeah.
Well, you're going to be able to eventually.
Well, exactly. and I think there's a misconception where if it's in an SMSF, you can do whatever you want with that money. You can pull it out. Like I said, one of my clients was going, oh, well, I can just pull that out to buy do it as a deposit. I'm like, well,
Yeah.
who's told you that?
Yeah, you
Have you?
definitely
Who's
cannot.
given you Who's given you advice for that, and where have you seen that information from?
We've had that before. People think they can. I mean, I think quite. So financial planners need to do 40 hours per year of professional development, just like online education stuff, right?
Yep.
And almost always there's I think I'd like as an industry, we always love to throw like random self-managed super fund complexities. So, for example, if you have a self-managed super fund bank account, there is a BSB and account number attached to it. That is there, and I think depending on what bank you're with, you might even have a debit card. Why would you have that debit card? Well, you'd be using to pay for a plumber, an electrician, whatever it is, bits and pieces you got to use for that. And don't forget, now we've got the sole purposes test, which is you're not allowed to use your super fund for any benefit. But what happens if you accidentally use that debit card at the supermarket?
Yeah, far out. What does happen?
Contravention report most likely.
Okay, you're going to
Your
have
auditor's going to sting you for $300.
You're going to have to book a meeting with us. You're going to have to book a meeting with us, and we'll tell you.
Yeah, right.
That's what we're going to do.
Yeah.
Yep.
It's just such little things. The reason I had the stab about your auditor charging you $300, I'm happy to call myself out here. I got caught out. Submitted a paper form for a rollover, like only a couple of weeks after the SuperStream rules. So there was a change in rules about how to process rollovers. That's a contravention because I processed a rollover the wrong way. The money went to the exact same place it would have had we processed it a different way. Because of that, contravention report to ASIC, $300 bill from the auditor. Thanks very much.
And that's it's such a heavy superannuation in general, and obviously, and umbrella that with financial planning is so heavily regulated.
Yeah.
As well, right? One wrong tick
Yeah.
in a box, it just completely changes everything.
Yeah.
And that's why you have the checks and balances.
The other one I'll call out too is you talk about the sole purpose test a lot, and like it is reasonably well known, I think, by a lot of people I speak to. I buy an investment property.
It's not well known enough.
It's not well known enough, but I buy a property through my super. Yes, I can't live in it. Yes, I can't rent it to any family. It's got that is at least somewhat well known. But what a lot of people don't realize is it works on the flip side too, right? So just say I'm an electrician, I've bought an investment property through my super.
Yeah.
The tenants have an electrical issue. I just roll in there and fix it. If I don't bill my company,
You got to bill at market rates.
at market rates, I've now made effectively
Capital
that's a
development.
contribution to super. That's not an arm's length income into that super fund. So that either needs to be recorded as a contribution to the fund and fall under my contribution limits.
Which is good. You get to make that contribution to the fund.
Yeah, or it's a breach. But it's like little things like that people don't realise. It's such an easy mistake to make,
Geez, I didn't know that. That's
Yeah,
something I've
there
learned
you go.
today.
So-
Yeah, so just going around making your own fix-ups and stuff
Yeah.
is,
Literally.
is something you need to be really,
Yeah.
you can actually, it's a benefit to it as well as you're just mindful of it.
You
Yeah,
can't
capital
derive
improve-
benefits, you can't give it benefits.
Capital improvements are a thing that just come back to us and talk to us about it, or talk to your accountant about that.
Yeah. No,
E.g., and capital, we mean fixing bits up. But what about if you want to put an extension on? What about if you want to change the garage?
Yeah. Right. Okay. So you got to, again,
Future.
any change you need to make.
I just think
Pretty
the
much
easiest
coming
way to
at us.
approach it, regardless of what your skill set is and what you think you can and can't do, just engage someone else and just keep it clean.
Yeah.
It's the simplest thing to do.
Keep it at arm's length.
Yep.
Yeah.
So engage an electrician, pay his bill, out of your fund, move on with your
I
life.
understand. We're getting stuck in the weeds here.
Yeah.
The answers are a common question that we might just sort of close on is like, what do I need to do to get a super fund? What are the steps involved?
Yeah, go
Well,
for
the
it,
physical steps involved are you need to get a director's ID. The director ID is the most difficult one that we talk to people about. So a director ID is a separate MyGov app. It's not the MyGov app you've got. You've got to get a MyGov app ID to set up, then go online to then apply for your director ID, which is unrelated to your tax file number.
Yes, I've done that. Yes, that's painful.
It was a fun experience, wasn't it?
Oh my
Yeah.
God. Yeah, lost a bit more hair.
Yeah. And I threw my computer out the window. But anyway.
I don't know what you guys are talking about. It was fine. I just went online and did it. It took me 5 minutes.
Well, they've obviously improved it since I did mine.
I say that in jest because genuinely I've had clients do it within 5 minutes. So don't get worried about it. If you are going, oh my God, I just don't want to do this at all. Look, it's actually fine. I have actually had someone, literally you just log in, you go to the MyGov ID app, download that, then you go to the MyGov Director ID link, you log onto that website, the app generates a code, which you can then log in, link to the tax office, which then allows you to generate
You're not making it
director
sound
ID.
easier.
It was like 5 clicks. All right. It takes you 5 minutes. Or if you don't have a passport and your driver's ID or your Medicare card, that's when things slow down. Because to get this MyGov ID app, you need to have strong security.
Yeah, strong
Yeah,
security.
Extremely strong. I'm not sure. what it-
Just strong.
Strong. And that's 3 government ID documents. So you got to have that ready to go. So first of all, we need that. Second of all, you need your tax file number. Thirdly, you need a name. And don't call it something stupid because you're going to have this for the next 30 years. So if you call it,
I don't know.
Sesame Street's self-managed super fund, right? Or if you call it like, I saw one, no red pen super fund.
No red pens? Probably because when they were signing the papers, though.
Correct. Now you want to keep it somewhat. There's a bit of an art to it, right? Because if you've got a really generic sounding fund, Smith's Family Super Fund, it gets lost a little bit. So it does need to be unique. It just needs to be not dumb. So you want to call it.
Not dumb.
Just don't call it dumb. So you want to call it. So say for example, the Jackson and Family Retirement Fund. That's easy. That's unique. That's available. That works fine. So have a think about what you want to call the fund because you're going to be referring to this every year for the next 30 years. And then once you've sort of have those things ready to go, assuming you've got the decision, you want to set up a super fund, you want to buy a property, you want to be a bit more self-directed, but you're prepared, you're organized, you're ready to go, and then that's basically it. You just need to be prepared to work through the process, and a bit of work up front will hopefully allow you to achieve your goals, which we're coming back to, of a more abundant retirement, because that's really why we're doing this. You've got greater control. Potentially, if you're borrowing to invest, you're hoping to get some more capital growth. And the final point is work with a really good estate agent around the property selection. Yep. That's a common thing. Yeah. That's a common problem where people are. I think like one of the most common complaints are someone buys a self-managed super fund. It's an off the plan or something like that, and then the valuations come out of like, let's say it's a 660 purchase price, and the valuation comes in at 640. 630, something like that. What actually, from a lending perspective, what happens? So I sign a contract at 660, and the val comes back at 645.
Yep. So if it's for an existing property, it's not a off the plan. So let's talk about existing. If it's shortfall, you've got 2 options. You can either you'll pay the difference. So the bank.
So how much do I have to come up with?
The difference. So basically,
I need to find 30 grand.
Yeah, 20 to 30 grand. Yep. So
and how much time have I got to find that money?
Well, if you're within the finance clause, well, do you have the money or not? And then we can say if you don't have the money, we can pull it on finance. However, if you're off the plan, you've already committed your 10% deposit 12, 18 months ago, right? Now it's come to realization that, we've got, we can get valuations done on the property. Valuations now, what you purchased it for 700, it's now worth 650. You either lose your 10%.
You need to come up with 50 grand.
Yep.
Brutal.
Yeah. You need to either pay the difference or you lose your 10%.
Yeah, so you're either giving away your deposit or you're just piling more money into something that's instantly worth less than what you were planning on anyway.
Correct. And that's the trap. That's the trap with not a trap, but it's a pretty high risk thing going into buying off the plan in an SMS or buying off the plan in general. Sometimes it works. Don't get me wrong. Sometimes it really does work. If you've got enough buffer in place, if you've got enough deposit for a 10% variance or something along the lines of that. That's when I'd probably go, hey, look, it's going to cost you this right now. But if there was a variance and it's going to cost you this. So we do that. We do those calculations up front. We actually had one that she bought it. 865 was the amount and the valuation came in at 800. 7-day finance. It's a 7-day finance one. There was so many other issues with it.
What does a 7-day finance mean in that context? Was that inside a super fund?
Yep, self-managed super fund.
Whoa.
We had 7 days finance from the contract date, 30-day settlement, and basically we didn't get the valuation till day 7. Just because the valuer couldn't get it. Like 7 days, a pretty short turnaround for a valuation, but we got it done. Read the valuation and just went, holy moly! I just said, you don't have the money. It was already in with the lender, and I just said, lender, no, we can't do it. There's not enough money, and they just, we wrote out a letter of finance decline letter saying we just don't have the money to kind of.
So 10% deposit gone?
No, because we're in the finance clause. Oh. Yeah. So we're still in the finance clause. She also had really good solicitors behind her. We were all talking, and I said, here are the issues. Bang, bang, bang. We just all collaborated. I mean, she was out maybe $1,500. That's solicitor's fees
Yeah.
Yeah, okay.
for the checks and stuff
Yeah,
like
okay.
that.
But you're able to walk away from
But
that.
we'll walk away from a $65,000 deficit,
Yeah.
right? And a pretty crappy property, to be quite honest.
Yeah.
So yes, that's the value of getting that advice, having the right people. But, you know, one of the other things was she was in the middle of a rollover. The money actually hadn't hit the SMSF, and I'm going, come on, mate, let's go. And that was due to, they already had it in place, and it's, you know, they were just taking their time doing it.
Yeah.
But she was proactive in getting it done. But
It's
now,
definitely something to be aware of when people are talking about, you know, finance clauses and timing and contracts and all that sort of stuff.
Yeah,
It can, especially if it's the first time you're rolling over out of somewhere into your self-managed, it can take some time and prepare, like especially if you're with, I won't name any funds, but some of the larger ones out there, you will meet some resistance. It's not an easy process sometimes. You know, our
They
team
might even call you.
They might even call you. You know, when we're working on that stuff for our clients, typically all the client will see is they've signed something for a rollover and the money hits their bank account, but the amount of work our team's doing in the background to make that happen smoothly, it's huge. So it's not always a simple process.
just like
allow time. Don't expect it's going to be 3 days like the legislation says, because it may not.
it's just like what we do.
Yeah.
You only see this, but there's actually all the stuff happening that you don't even see or need to see. But you know, that's that when someone comes up to me and the first thing I ask is, oh, cool, have you set up your self-managed super fund, trust, the account, have you rolled your money over? Well, if you haven't done any of that or you haven't even got any advice, pause. Can we just, here's a list of people to go get the advice, because you could be putting yourself in a very risky situation if you're going to pull it out and pull that stuff in. So, yeah. That's the skinny, right? Like it's got its pros and cons, just like any investment. But the overarching thing is, before you do anything, seek advice. Speak to someone that actually knows what they're doing. They're trained in it, and therefore you can make the most the decision that best suits your requirements and objectives. Right?
We've hit the tip of the iceberg today. They're a complex structure. There's a lot that can happen.
Yeah.
You know, we make it simple for our clients, but you're absolutely right. And whatever you think about doing, you need to speak to someone first. Don't just jump in. There's a lot of stuff you probably don't know.
Exactly. No, cool. Hey guys, really appreciate you guys coming on today. I hope you have a safe flight back to Melbourne, and you're probably going to be wearing multiple layers by the time you get back.
My jumper and my jacket are in the car.
Thanks for coming on board. Look forward to having you both, or at least one of you back. Both of you, next time you're up, back on the podcast, we'll talk about something a little bit different and what's happening in your world, changes in your world. But again, how do we get a hold of you?
Yeah, so wealthlab.com.au would be the best place to start. There's a link there. You can book a chat with us. And
cool. Find you on Instagram.
That's it. We're on the socials.
Yep. All the socials. Fantastic.
Yep.
Cool. And as always, everyone, the advice on the show is very general in nature. You must seek advice from a professional in that field before making any decisions for your own personal circumstances. And as always, we don't have advertising. We don't pay for advertising. We're here to educate. Doesn't cost you anything to do these next three pieces. Follow the guys at WealthLab on their Instagram page for some little nuggets of gold. I think there's a few podcasts on there as well that they're doing. Follow me, Dion, at Dion Finance Specialist, and follow the podcast at Finance This Property That. You'll also be able to hear this podcast on Apple, Spotify, YouTube, all the usual suspects. And if you like the visuals, this will be up on YouTube as well.
Right.
Beautiful.
Thanks for listening.
Thank you.
Thank you guys for coming.
Yeah, thanks for having us, mate.
No worries.